is they are giving us all the accounts in the balance sheet section, which just means those things that we look at and we say that is our picture for the year, and then everything in the nominal account section. And they say to us, okay, calculate the net working capital. Okay, so now obviously in all these cases they are going to give us amounts. I've just blacked them out for now. So let's just go and put those amounts back. If I do it in the right one. Okay, so those are the amounts that you were given in each case. Now let's think about it logical. Really, your assets and your liabilities are not things that you will look at over a full year. You're looking at your assets and liabilities over at a period in time. It's a snapshot of a period in time, and therefore we are expecting to find our assets and liabilities in our balance sheet section. So let's just have a look. For now, let's color everything that is a liability in a pinkish color, which just means red for danger, but we're not going to do it too much yet. And then we are going to now identify all of those current liabilities first. So we say that's the loan, or not the current, all liabilities. If it's liability, we're going to discover whether it's current or non-current later. We are just looking for all liabilities. Okay. Now, it should not surprise you that when we look at our liabilities, that on our trial balance, all those amounts will be credited. Okay, but we are not looking at our capital and our drawings. It does not form part of our working capital. Now we go and find everything that is an asset. Trading inventory is an asset. Input VAT is petty cash, equipment, vehicles, debtors control. All of these are our asset accounts, and we're happy with assets, so let's make those green. Okay, when it comes to everything else, okay, it's either an income or an expense. It is not an asset or a liability. We are only looking for assets and liabilities. When we think of our accounting equation, capital and drawings falls outside of that, and all these income and expense accounts fall outside of our asset and liabilities. Okay, so now we say, okay, what we now need to identify is this asset or this liability, is it current or is it non-current? So now we say, okay, let's have a look at trading inventory. Trading inventory is current. We're going to leave it there. Input VAT is current. So we are going to leave it there. Petty cash is current, so we're going to leave it there. Equipment, oh no, wait. Equipment is actually a non-current liability, so I am not going to use it when I calculate my net working capital. Same with vehicles. No, goodness, vehicles is not current. Let's take that out. But debtors control, yes, that's current. Okay, so now I'm saying to myself, really, as far as I can see on this sheet of accounts that I've been provided, there are only 1, 2, 3, 4 current assets that are being listed. Now, what about our current liabilities? We have a loan from ZZ Bank. It's not telling us that any of that is due in the year, so we're going to treat it as non-current. Bank overdraft is a current liability. Output VAT is a current liability. Creditors control is a current liability. So now we go down and we say, okay, let's have a look here at our current assets first. Okay, we must list them. and we can list them in the order that we have. It's trading inventory, input VAT, petty cash, and debtors control. So let's list them, all of them there. Those are the 4. Then we look in here and we look at the amounts that apply to this, and we simply fill in those amounts. And what are we supposed to do then? We are supposed to total it so that we can see what our current assets are. Then we do the same for our current liabilities. We will see there's only 1, 2, 3 there. Bank overdraft, output VAT, and creditors control. Okay, let's list them. Let's record the amounts and let's add them. Okay, now we must find our net working capital. And the way we found our net working capital is simply by taking the total of our current assets, dividing the total of our current liabilities, and then we get the answer there of 3,846 Rand and 72 cents. Now the next question says, is explain the working and reasoning for entering the following activities and explain what you think the effect of these activities will be on the cash flow of the enterprise. Now, I went and I wiped all of this out, which was not clever, because that doesn't give them the opportunity, or gives me the opportunity of actually looking at what the activities is that was listed. Okay, so let me quickly, oh man, sorry, just pretend that you didn't see the answers, okay? And then just look at what was good. So, okay, so now they say, this is the activity, explain what can happen. So debtors taking extra debt. Now think about that. If they take on extra debt, then what's going to increase? Debtors control is going to increase, so our net working capital will increase. Okay, so you can simply say that. Wonder if that's all I said there. Let me see. Okay, debtors control increases and working capital increases. Okay, that is fine enough. What about receiving payment by credit card? Okay, if we receive payment by credit card, actually it's our cash that's increasing, and therefore our working capital will increase again. Remember, when we receive a payment by credit card, that has got nothing to do with us. It's not a credit transaction. When we take a credit card payment, it is a transaction for which we get cash. It is just another agreement between that debtor and his bank. He owes his bank the money, the bank gives us the money. So it's a cash transaction on our books. So we say that cash increases and working capital increases. What about slow-moving inventory? Slow-moving inventory is a bit of a problem, because it means that it's still going to be in trading inventory, so it's going to stay constant, but we're not turning it into cash. And what happens if it takes longer than a year to get rid of that trading inventory? Okay, so we say working capital is tied up in slow moving stock. Okay. Because remember, if we do that asset test, we would have subtracted the inventory from the other assets. And then the last one is using purchase and lease back or hire purchase for the purchase of fixed assets. Okay, now think about that. We're using purchase and lease back or hire purchase for the purchase of fixed assets. Well, it really means that our creditors control is going to increase. While, because it's for fixed assets, our current assets is not going to increase. So our current liabilities rather is going to increase, but our current assets is not, because it's a fixed asset, long-term asset, or non-current asset rather, and so therefore our working capital is going to decrease. Let's say that. Welcome to my video. I'll trust you'll find it helpful and informative. please remember to like and subscribe. Thank you.
Thank you for watching this video to the end. If you found it valuable, please subscribe and like. Thank you.